$120,000. Yes, you heard it right. That's the amount that my wife and I have invested in 3 specific funds over the past couple of months. Well, in this video, I'm going to be sharing with you why I don't think we are overexposing ourselves by selecting these 3 funds, and in fact, why we are going to be increasing our investment in these 3 specific exchange-traded funds over the next couple of months by almost double that amount of investments in total. Want to find out what those specific funds are and why we are investing in those? Then watch this video until the end and let us know what you think. All right, here's a quick tracker that we've put together, capturing the 3 specific funds that we pointed out. We've invested over $120,000 over the span of the past couple of months. 2 of these holdings are the ones that we've recently added to our positions much more aggressively. And one of them, in this particular instance, VEQT, as you noticed, is the one that we've had as part of our Smith maneuver. Currently, VEQT is the one that we have the most amount of exposure. We have close to $84,000 put into VEQT, which is Vanguard All Equity ETF portfolio. It's an all-in-one kind of a balanced portfolio, giving you exposure 100% to stock market, but exposure broadly to geographical diversification and industry diversification. In other words, by investing in VEQT alone, which is a Vanguard product, we are kind of getting that proper diversification throughout the stock market. Now, recently, as I pointed out, we've added to 2 other holdings. We've added VFV as well as VDY. You notice some of them are added to my personal kind of accounts, including my registered retirement savings account, as well as tax-free savings account. And 2 of them are added to my wife's accounts. So we've just added them. You notice how many shares we currently own of these portfolios and what's our cost basis. We've also listed out the 52-week low price as well as 52-week high price for these funds. Now, I want to share as well why we've picked these 2 additional funds and added it to our portfolio. As for VFE, which is Vanguard S&P 500 Index ETF, it gives you exposure to the 500 largest US companies. So we are getting a little bit more exposure to the US stock market through VFE. This fund is available in Canadian dollars for us. Given that we are based in Canada, it easily allows us to get that exposure in Canadian currency without having to worry about any funds commissions when we are buying or selling these kind of ETFs, because we are using our Wealthsimple Trade account. We do have links to signing up to Wealthsimple Trade if that's something that interests you. It's a promotional link and you would get some benefits through using those affiliate links provided in the description. As for VDY, here, the strategy behind picking the VDY is a high quality, reliable ETF that gives us exposure to Canadian high dividend paying stocks. So we wanted to also get some additional exposure to Canadian stocks, and in particular to those that have a high dividend paying yield. VDY gives us that, and we've been aggressively adding to our shares. Currently, we have closer to 950. As you see, this is the total amount of shares that we have of VDY. With VEQT, we have this total amount, almost 2,300. And with VFE, we've also got actually to buy close to 250 shares of it. The approach around picking these ETFs are slightly different. With VEQT, we wanted to get more of that diversification. We would like to keep this around that 50% or about 45 to 50% mark in terms of our total exposure. With VDY, we are aiming to get much more exposure to higher dividend yields to the Canadian stocks. And with that, we are going to be willing to bring this up to close to that 35 or even 40%. And with VFE, we are getting a little bit more exposure to US stocks. And here, the interest that we have is much more towards the rapid growth. Here, you're not necessarily looking into much of a dividend, because with VFE, it has a very low dividend distributions, and more so around rapid growth that we are going to see through S&P 500. Obviously, S&P 500 has not been doing the best over the past 1 year, but we are thinking this is a perfect time to add to more shares of VFE. In fact, looking at the current market value for these funds, as you notice, the market value given the last trading price for these funds are definitely lower than what we've bought them for. You can see here the cost per share that we've paid for, as well as the price and the last trading price for them, hence resulting in a negative return overall for this kind of positions. These 3 positions, we are down by about 12.5%, but we are not worried. In fact, as I pointed out, we plan to deploy at least similar amount, almost doubling this portfolio size over the next couple of months. And that's the intention. We did wanted to kind of get a sense of how much dividend we are anticipated to get from this portfolio of these 3 positions alone. And the dividend estimated for 1 year would be around that $2,200 in dividend. Now, with that, we decided that what happens if we deploy a lot more funds into VDY, which is obviously the highest dividend yield, close to that 4% yield. If we did that, although the breakdown would definitely change drastically, it's not going to be around that 35% or 30%. But let's say if we really sacrifice the breakdown between these 3 funds and wanted to really aggressively go for much more dividend, that would bring us with $200,000 extra investments. That would bring us to an extra dividend expected of $8,200, which could bring our total dividend in a year to around $10,000 to $11,000 in dividend income alone for these 3 positions, assuming another $200,000 is deployed and based on the last trading price for VDY. Now, it doesn't mean that we are going to necessarily do that over the next week or 2. This is a more of a longer term plan, but we do intend within the next couple of months or to 1 or 2 years to deploy much more funds, and that's why we are having some of these projections here. We'll definitely continue to provide an update on this portfolio, but before we do that, I want to also share with you a quick comparison of these 3 funds. We are using, for this matter, the tool offered by BMO. BMO Global Asset Management has this kind of comparison tool that you can add different funds, whatever you're interested in, and kind of compare them head to head. We are going to take a look at VDY, VFE, and VQT. The funds prices is not that much of a difference. We saw that before. The objectives of these funds, I walked you through kind of that. As indicated, all of them are traded through Toronto Stock Exchange, which is perfect for Canadian investors. Now, the inception dates for these funds are different, although both VDY as well as the VFV are showing their inception exactly in November of 2012. For the VEQT, which is an all-in-one equity portfolio fund, it has an inception most recently, back in January of 2019. We're going to take a look at the management expense ratio here as well. You notice the lowest MER belongs to VFE with only at 0.08%, which is very low. Means if you invested $10,000, the fee deducted as a result of that would be only $8. Then the next fee in that sense from an MER perspective belongs to VDY with 0.21%, and then following that is VQT with 0.25. The VEQT charges a slightly higher MER, but at the same time, keep in mind, it's just making it so easy, gives you proper diversification and geographical distributions and diversification without you having to worry about anything. You can just buy into VEQT, and that way you're automatically diversified nicely and 100% exposure to the stocks. If you look at the past 1 year return for these funds, you notice the best 1 year return actually at the end of August of 2022 belonged to VDY, and there you're seeing the return of 8.7%. Following that, you're seeing the other 2 funds are showing negative returns. For VFV, you're showing negative 7.9%, and for VEQT, even worse, it's at negative 10.3%. Although it's not the greatest return for those 2 funds, again, keep in mind, we are here in for the long term. That's why we welcome these short-term kind of declines and are willing to add to our existing. If you look at their returns since their own respective inceptions, and keep in mind, we talked about their inceptions are different. 2 of them starting their inception back in 2012, and VEQT starting its in 2019. The best return since inception belongs to VFV with a cumulative return of 329.99%. Just amazing, 303% return. Just knocks it out of the park in comparison to any of the other funds. That's why we want to get some exposure to VFV, because of that more of a higher growth potential. Then with VDY, you're getting that next best return of cumulative 139.9, close to 140% return. Again, just an incredible return. And then with VQT, it's not been around that long, hence it hasn't had enough time to actually have that cumulative compounding growth. But VQT, we are seeing 32.8% return. If you look at their returns based on common inception date, which goes back to around that early 2019, the best performance belongs to Vanguard S&P 500 Index, VFV, with a total return of 53.6%. Following that, we have Vanguard FTSE Canadian High Dividend Yield Index ETF, or VDY, with a return of close to 49.7%. And lastly, we have Vanguard All Equity ETF Portfolio, or VEQT, with a return of 32.8%. You're also noticing the returns over the different recent time horizons. In terms of what these holdings or funds consist of, for VDY, it consists of 48 different holdings, Canadian stocks. And if you look at the VFV, it mainly consists of the 500 largest holdings in the US S&P 500. As for VEQT, it consists of 4 different holdings, and the reason it says 4 different holdings is not really truly 4 different stocks, but rather 4 different other underlying ETFs. Same goes for VFV. It's the reason the number 2 is shown here. It can be misleading, but it's actually giving you exposure to the 500 different S&P 500 stocks. In terms of the market capitalization, as shown here, 1.1 billion for VDY, 4.5 or 4.6 billion for VFV, and almost $1 billion for the VEQT. Lastly, if you look at the biggest holdings, top 3 holdings, for VDY, we are looking at Royal Bank of Canada, Toronto Dominion Bank, and Enbridge in terms of the top 3 holdings. For VFV, we are looking obviously at the underlying holdings. In this case, it's not really truly showing the stocks because it's trying to show you actually the underlying other ETF funds, in this case VOOO, as well as the index futures for VOO are showcased. But if you look at truly the stocks underlying that, you're going to be seeing a lot of the FANG stocks, things like Apple, Facebook, Tesla, and so on and so forth. And similarly for VEQT, again, the underlying funds are shown here, not truly going and showing you the stocks. If you are interested to find out more about the specific companies that you're getting the highest exposure, you can simply look up the details through the Vanguard website by looking up these ticker symbols. In terms of the sector breakdown, the highest exposure you're getting for VDY is financial services, energy, and telecommunications. As for VFV, your biggest exposure by sector is to technology, healthcare, and financial services. And lastly, the biggest exposure by sector here is shown as exchange-traded funds, other ETFs, financial services, energy, and basic materials are among the top exposures. For VDY, you're getting 100% exposure to Canada. For VFE, you're getting 100% exposure to US stocks. And when it comes to VEQT, given that geographical diversification, you're getting about 44% exposure to US, 37% exposure to Canada, and the remaining 18.5% exposure is to international businesses throughout different geographical locations. Well, there you have it, folks. A quick look into 3 major exchange-traded funds that my wife and I have been investing in recently, and we're continuously adding to our existing positions here. As you notice, it is more of a passive investment approach. It doesn't mean that we do not have any active investment. We do still buy shares of some stocks and do extensive research on those shares. And that's how we make these videos for you, other videos on the channel that you've seen around our research of different stocks. But we're kind of leaning a little more towards passive investing, given the low risk with it, and perhaps allowing us to have a better sleep at night as well. It comes with a little bit of that risk tolerance. But at the end of the day, this is based on our own research and our investment approach. We understand that people and any investor can have their own approach when it comes to investments in the stock market or any other investment channel or avenues that exist out there. We hope you found this video beneficial and gained you something of value from it. It's truly meant to be for entertainment and giving you some thoughts and food for thought so that you can start your own journey, hopefully, in building wealth and reaching financial freedom. I hope, as always, you continue to support us on this channel by liking this video. It really means a lot to us. And of course, subscribing to our channel. Here on Moementum Finance, we post every week several videos about investing, including investing in dividend stocks, growth stocks, exchange-traded funds. We also talk about investing in crypto, as well as ways to reach financial independence and financial freedom. Thank you, and I hope to see you next time.